This is Jody Trana with Chapter 3, Part 3 of Principles of Accounting. In accrual basis accounting, we use accruals and deferrals to put revenue and expenses into the right time period. An adjusting journal entry is made at the end of the accounting period, and it's used to record revenues into the right period in which they are earned and expenses into the right period in which they are incurred. Deferrals defer the recognition of revenue or expenses to a date after the cash is received or paid. Accrual adjustments are the opposite. An accrual records an expense before the cash is paid, or it records the revenue before the cash is received. It's more important for you to understand the concept of deferrals and accruals than to try to memorize which one is a deferral and which one is an accrual. We'll talk more about this. Here's some guiding principles to think about as you are writing your journal entries to adjust revenue or expense. First of all, they're usually written at the very end of the period as an adjusting journal entry. Second, they never, ever affect cash. And third, because we're always trying to get our revenue and our expenses correct so that our income statement is correct, we are always either adjusting a revenue account or an expense account. This means that in our adjusting journal entries, we will always have either a debit to an expense account or a credit to a revenue account. Here we have an adjusted trial balance. For a minute, let's review this trial balance and look at the format just to remind ourselves. An adjusted trial balance lists all accounts for a particular company. Every account is listed with its balance, usually the normal balance, of a debit or a credit. Each column, the debit column and the credit column must balance. We also list all of the accounts in order of our account categories. Assets first, in order of liquidity, that's how quickly they turn into cash. Liabilities next, and we usually list accounts payable first and everything else in order of how quickly we're going to pay it. Equity next, revenue next, and then finally expenses. Both revenue and expenses are listed in order of greatest to least. Let's talk about where an adjusted trial balance comes from and its significance. An unadjusted trial balance is what we start with. It is usually our trial balance that is at the end of a period but does not have any adjustments considered for it. We're just taking our most current list of all of our accounts from our ledger, and we are putting them in a report to make sure that all of our ledger accounts balance. That's the purpose of our unadjusted trial balance. Then we make adjusting journal entries. Those are usually journal entries that happen at the end of a period that are made in order to get our revenue accounts correct and our expense accounts correct. We need to post those journal entries to our ledger accounts, and once we do, we have new balances that we need to put into an adjusted trial balance. At the end of every fiscal period, an adjusted trial balance is prepared. It is considered more accurate than the unadjusted because it includes the adjustments. It will be a summary of all accounts with their adjustments. The purpose of doing a trial balance is to make sure that your debits and your credits equal. It can often be very helpful to use a worksheet when compiling the end of a period trial balance and financial statements. Here you'll see a worksheet where you can only see the first two columns that relate to our unadjusted trial balance. We have both debit and credit columns, and they do agree, and all accounts for this company are listed in the order that we have discussed. The adjustments column is where we list all of the adjustments that have happened. These adjustments come from our adjusting journal entries that we have written in our general journal. These amounts are shown here as either debits or credit, just like they were shown on our journal entries. And you'll see here as well that our debit column equals our credit column. That's because our journal entries were in balance. You can see that many of our entries here are affecting revenue and expense accounts, and none of our entries are affecting cash. That follows the rules of accruals that we've talked about. Our next column has our adjusted trial balance account balances. You can see by looking at each one that the unadjusted balances were affected by the adjustments to come up with our new balance. Let's look at two accounts. First, the cash account. The cash account was $12,200 in our unadjusted trial balance as a debit. As we have talked about, cash is never adjusted in our adjusting journal entries, so it has received no changes. Therefore, our adjusted trial balance is the same amount, $12,200. Now let's talk about accounts receivable. Accounts receivable was $1,000 in our unadjusted trial balance. One of our adjustments, labeled H, is a debit to $800. $800 is an increase to accounts receivable, and it's also an increase in service revenue below. We would take $1,000 and add $800 to it to get our adjusted trial balance of $1,800. Sometimes accounts that are affected as a decrease are more confusing than those that are affected as an increase. Let's look at one more. Office supplies had an unadjusted trial balance, debit balance of $500. One of our adjustments was a credit to office supplies of $400. We were moving office supplies out of our asset and into our supplies expense. This credit reduces our debit office supplies amount, and now we have a debit of $100. Another reason to use the worksheet at the end of a period is it can help us compile our financial statements. The next column is empty, but this is where we would record our income statement numbers. If you'll remember, the income statement comes from the accounts that are at the bottom of our list, starting with service revenue of $17,500, including all of the expenses down to the interest expense of $100. These amounts would show on our income statement in our income statement columns here on our worksheet. And finally, the last column is for our balance sheet. You will remember that our balance sheet includes the accounts that are in the accounting equation. Assets equals liabilities plus equity. The balance sheet also must balance, just like your trial balance, your adjustments, and your adjusted trial balance. In order to make your balance sheet balance, you'll need to use your profit or loss from the income statement as part of your capital amount in order to balance.